This is Justin Pulitzer. This is my weekend review for Sunday, December 27th, 2015. The year 2015 is winding up. This is obviously going to be the last weekend review of the year, but have a lot of good stuff to cover, so let's get into it. As always, we start with the themes, being the 6 market keys and the 6 Fed keys. So I'm going to just run through those. Then we're going to get into the major market indices, cover FANG, and a couple of other big momentum stocks that are key for the market right here. Anyhow, let's start with the VIX. You can see we have been making here a series of higher lows and starting to try to challenge to make higher highs. But this past time we did fail slightly. We couldn't get really above 25 and sustain, and we've come back down. The bad news is we are down now near toward the lower part of the range, and I would say that the risk of volatility going higher here is probably a safer bet than playing for a complete collapse in terms of risk reward. It is possible that this week, we are kind of just going to chop into the end of the year. Maybe it does want to just drift a little bit lower, but I would be more of a directional player here via long calls or long puts, meaning long spreads, as opposed to selling volatility down at these lows. We are in a little bit of a compression range. You can see I've drawn in some lines. The horizontal lines being the most important, particularly lately this 25-20, because once we start closing above there is crash risk on the table. Right now, we're kind of just compressing between low volatility and more elevated volatility. It wouldn't shock me to see another move back up into there, or maybe early in the year. So right now, VIX currently in the lower part of the range. This is sort of the lower part, this is the middle part, and then this is the upper. Anything above there, we get scared for crash risk, particularly if we start taking out the 25-20, and then anything over 3106 is really seriously more danger zone. But here we are, lower part. I would be a little bit more conservative. The dollar. So this has been a really big problem, and I've said could be the biggest problem the market faces. The good news is we are starting to put in lower highs, not yet really some lower lows, but we have maintained the trend. You can see we stopped right there. The good news is that anything below 25.68 in the UUP, which is our proxy here for the dollar, is kind of safer. Anything above there puts the old highs into play, and that could cause trouble for the markets. So the dollar doesn't really need to completely tank. It just can't start rampaging higher. I would be a little bit cautious, though. We are right on trend. This could, if it does start to rally, become a problem again for the tape. The bonds. So TLT, I've long discussed this 2009 crash peak. This chart doesn't go back that long, but take my word for it. That has been important. It was some resistance here. It was some support here, and then some resistance again here. And we've been teetering around that area. The good news is we don't really even need to see bonds rally so much as we just don't need to see them fall apart. If they start to fall apart, the market is going to get iffy. There is the inverse relationship between price and yield. A lot of people say that bonds rallying is bad for the stock market. That is complete BS. The lower yields go, the higher PE multiples expansion is. So as bonds rally, stocks become more attractive. As bonds sell off and as those yields rise, stocks become less attractive. Always remember that. Don't listen to the media. They don't know what they're talking about. The only time you really want to start worrying is if there's like spike type moves, because that has people thinking there's recession on the table. Anyway, we have a pretty defined range here. The 118s being important, 126s being important. We are now basically mid-range, right near a high volume distribution. I would wait for a violation of the range to the lows or a violation of the range to the highs to really start getting involved. Right here, it's just all guesswork, although I will say anything below 123.15 remains vulnerable to still lower. My big fear is that we're going to start having a situation with rates like we have with oil. I don't know if that's going to be an issue just yet. It might become a first quarter or a second half of the year story for 2016. But if this starts going down every day, like this type of action, or I will show in oil, that is going to become a major, major problem for the market. Currently, the algorithms are keying off oil, but if this does start really dumping, they are going to start keying off the bonds. So just keep that in your back pocket. It's not really a problem yet, but it is one I'm anticipating could potentially be a problem further down the road. Let's just cut to the heart of it. This has been a really big problem. Junk has been cut in half, JNK from the rally. It's still below the channel. That is weak. The good news is we are starting to make some higher lows. We just need to make some higher highs, and maybe we could get some type of a throwback into some reference areas in the range. This falling apart has people reminiscent of the financial crisis. This, the stress always happens. I guess they always say you're only as strong as your weakest link, and high yield is always the weakest link because it's by nature the most stressed balance sheets. So you can see we've been in a down channel and now also a downtrend within a down channel. Not a pretty picture. You really need to start seeing that reverse, and then if you do, that would be very helpful for the stock market. The good news is the stochastics are bombed out. They are starting to kind of try to bend back up. That would be helpful if this does start to rally. It would be a little bit of relief for stocks. The other one, I shouldn't say not nearly as stressed because it is nearly as stressed, but it is trying to reclaim the channel a bit. Same story here, down channel, downtrend within a channel. Not pretty. You're below all your major moving indices and averages. You have, this is the 200, the 100, the 50, and the 20. They're all sloping downward. We're underneath them all. Not a good sign. The good news is we did hold roughly the 50% fib. I've been looking for the 61.8. Can see I have an alert down there. I'm looking to maybe buy for right or right out if we do get another leg down. But, if this stays under pressure, we did have a little bit of reprieve this week, hence the markets were able to rally. But if this starts falling apart again, it is going to be trouble. So let's talk about it. Oil. This is what the market has really been keying off of. You can see USO did make new lows. But USO is made up of rolling contracts, and I find the more accurate way to look at this is the CL. The 2009 crash low was 33.20. The breakout was 37. We roughly have been trying to bottom within that range, which is, I guess, good news. We did break a secondary downtrend here. We're roughly on the 20. There is some more room maybe for a rally still higher. I do think anything over 37s keeps 40s in play, which is where this breakdown really came from. So that's a good sign. It's also a good sign that we've now made a higher low and starting to make some higher highs. That's usually where patterns start to change. And what's also confirming that is the big bad boy, Exxon. So let me show you something here, which is a pattern I often like to see. You can see Exxon rallied up quite high. It did get to 87s. I've been saying 86 is really the my proxy for global growth. Anything below 83, though, is vulnerable, so Exxon is still a bit vulnerable. But take a look. Made a lower low, a lower high, a lower low. However, higher low, higher high from the swing trade. You had 1, 2, 3, 4, 5 days of sell-off consolidation from this kind of professional gap up, and then this day here, which was Thursday, broke the downtrend, professional gap and go, and took out all of these days of trading. The bad news is it did stop at the 50-day, and that we did have a bit of a pullback, but look where the pullback stopped, right on the downward regression line. These are proprietary lines that I draw in. You can draw them in too. It's just a matter of where to draw them from. I sort of I don't know. I guess I have a lot of practice with it, so they usually tend to be fairly accurate. Maybe I'll do a special edition video one day on how to draw these proprietarily and not, just rely on the studies. But I would say that Exxon is starting to look a little bit better. Like I said, the higher lows, now higher highs. I do have some short puts in here as a long proxy. I believe the strike is probably like 75 or 76. I'd have to check, but I am starting to get a little bit long back in Exxon. I had been long here. I did take profits, and now I'm starting. I had played it here short with put ratios. I talked about covering them. Now I'm back to trying a little bit long. So let's see how that plays out. But the good news is that I do believe Exxon would turn before the commodity turns. Just as a heads up, Exxon and Chevron probably have the best balance sheets of all of the oil companies, Exxon being the best in breed of them. Chevron, the CEO made it known that he was going to basically maintain the dividend at almost all costs, which I interpreted as them cutting R&D and jobs before they'll cut the dividend. Basically, if you're a shareholder, that's really what you want to hear. Exxon hasn't come out as explicitly saying that, but I do believe that they would be doing the same, and Exxon also has a better balance sheet than Chevron, which is also great. Exxon trades at a bit of a lower PE, and I believe that they will be well positioned to take advantage of the collapse in oil. If any of these firms go bust, they will have tons of balance sheet cash that they can swoop in and pick up assets, Warren Buffett style, dirt cheap. I also mentioned in a Periscope that Buffett had been long Exxon and exited kind of near the highs. Kudos to Warren. He's the best. We all know that. But these levels are kind of maybe where he got involved in the first place, and that could be an underlying put. Maybe Buffett is going to get back in on Exxon, and I'll tell you if he does. We all know when Warren is involved, the stocks tend to rally. Anyway, Exxon, in my view, is the best of breed. That would be the one, if you're worried about dividends being cut and you want to kind of play oil chicken little style, that's the way to do it. FXI. Now, I've talked about this, that this just can't be in crash mode. That's really when we get interested, when markets are in crash mode. So let me show you what I'm looking at right now, which I think is the kind of the way to look at it. You could see here, this was the support and really where the major breakdown took place. We rallied back up, retested it, and have sold off since. We have a bit of a double bottom here, which is good. And we are rallying back up to kind of retest where this shelf really broke down from, which was the 50% fib of this entire move. Anything below this 37.66 to me is a little vulnerable, so to speak. You can see there was a bit of a breakout there, and this is also where the old channel low was. The 50 MA is there. We are kind of bending back up in the stochastics, which is good. And we are kind of closing above 2 days above the 20, which is good. We're still in a bit of a downtrend, but I'd be a little bit cautious here. I think that there could be some responsive sellers. It might be an interesting right or right out short place. But if we could puncture through there and the bulls can take it back up, then I would start being a little bit more constructive on China. Like I said, just can't be in crash mode, but sideways to higher, always good. With that, most of people I talk to on the stream are interested in two stocks, Baba and Baidu. Baba is consolidating nicely. You can see higher lows, equal highs. These highs are poor, so that's what caused this liquidation break. It is encouraging that we're back up there. 82.81 can be your line in the sand if you're a little late to the party, if you want to give it a little more room, the 50 MA. But I would assume, and this assumption is a little bit dangerous, I will qualify this saying all things being equal, this pattern should resolve higher. Why are we running into so much resistance? Take a look at this volume profile here. Look where all of this volume was. All of these people back here who got long, sat through all this pain, are now able to be made whole and get their money back. So it's sort of a matter of when that alleviates. Take a look here. This is the end of the distribution. So if you bought really well here and you're kind of like, yo, I got good trade location, I'm going to stick it out. 7777. wouldn't it be ironic if it was 8888 because the Chinese all love 8s? But in this case, it's 7777. That is really the must hold. You can see that's where the distribution ends. Anything below there really gets iffy. I would say that this would be a failed consolidation if we lost there. If we can break out above these 86s here, I think we'll see 89s and potentially into the 92s. There was resistance here, we know, around 95. I do think that this stock will fill the gap at some point here and see 98 to 100 again. It's just a matter of time, but I would really wait for this. I would set a buy stop over here and try it for right or right out. The longer this consolidation goes, the better that buy will be because you'll have eaten up all this supply here and there'll all be new buyers. So that's how I view it. Baidu. I was bullish for their earnings. It got the channel high. It actually exceeded. It's just consolidating here. For me, the must hold here is this 94.31. You can see it's roughly the 61.8 also of the bounce back. We're kind of dangerously challenging it here. It's also this up channel. There's a 50 MA right below there. So I would give it a little room maybe to the 50 MA in this. So if you want to try some right or right out action here, I could countenance that if you think it's going to fail. Put ratios for some type of a gap fill down here, which would also be like probably 50% from the pullback range. I believe that would be a good play. So either way, or both. I mean, if you want to play long and you want to hedge it with that type of a short play for a move back from one volume distribution to the next, which would be like 176s, and the gap fill here being 168.99. So let's just say 169, and between 169 and 176, that would be your kind of lower strikes. And you would be playing for a move there, which I think would be a good outright directional play, or if you want to play it as a hedge, if you want to play it as against that long. The proxy for growth and risk on, risk off has narrowly focused lately on biotechs. We had a head and shoulders breakdown, the failed check back, double bottoms, consolidation. We are over the downtrend. We have two highs here, and we are now challenging it again. I would start being more bullish on biotech. What's good here is that we have a low, higher low, still higher low, and equal highs. So theoretically, I mean, to have good trade, really the best trade location, a pullback here to the 50 with a still higher low would be the best, and then to re-challenge this again. But I won't be a stickler. Anything above 342.48 to 341.25, which are these highs, is bullish. So if we can break above those, I would set a buy stop there for a right or right out long, which I think would be probably get a move back up into this area somewhere between 356.24 and 360.57. That's sort of where the next volume distribution takes place and really where this big breakdown took place. So I think that there could be a play there if you want to play it with call spreads or call flies or call ratios, however you want to play it. I do think that this will be some resistance. It will also set up for a good right or right out short again, of course. But I think a break of these highs will get you up there. And a pullback at this point, you probably could try long again for right or right out against the 50-day moving average. If you want to play put ratios, that's a way to play that as well. My favorite is this Gilead. Although the pattern here with this has not been acting well. I really wanted this to come down completely and retest these 84, 88 to 85. We have not had that yet. Their earnings are coming up. The ideal scenario for me, believe it or not, would just be for this to continue to sell off and get out a lot of weak hands before the earnings to set up for a long, but we'll see. If I don't know if I'm going to have my druthers on that. I did mention in my last video, and I posted the article, someone had asked for it, that some of Gilead's HIV medication is being used as more of a preventative measure with some of the grinder type of crowd who are using it listen, no judgments here. It is just being done, and this is demand for their drug being used as a preventative for less than safe sex. That obviously is good demand for their drug. I think it's called Truvada, and that is, good for Gilead earnings. I believe that the reason the stock has been under pressure has been because of this just some consolidation and sell-off. Also, some comments Hillary Clinton and some others have made with regard to drug pricing. And, this stock has always been cheap based on a PE multiple. The only problem is that stocks always look the cheapest at their peak earnings. So that is my fear. My big fear with this is that there will be regulation, and that will cause problems with this stock's earnings going forward. That being said, I like to buy it on dips into weakness. So we could also review here. Those were the 6 market keys. Just to sum up again: the VIX, the dollar, the bonds, the oil, China, and biotech. The 6 Fed keys, and the big question is going to be, was there a policy error with regard to the Fed? I do believe there is a policy error happening. I did say, though, that there is some credence to this dovish rate hike talk, because the Fed is continuing to do bond reinvestments, meaning as their portfolio would normally run off, they are reinvesting the money. Basically, it's QE light. So it's very hard for the Fed to affect yields if they're not forcing yields higher through sales of treasuries. If anything, they are suppressing them with the purchases of bonds. So the things to look at here are the jobs via the non-farm payroll, which is just kind of stagnating. I've gone on infinitum on my views about the jobs in this country, how I think that they are a lot of temporary, low-quality jobs, and that the unemployment statistics are greatly overstated with regard to their strength. I think it's a lot weaker than people realize. The GDP via Atlanta Fed, which has been revised down. I believe they're sub 2% at the moment for the fourth quarter. That is not good, and stall speed with risks. ISMs have been weak, both manufacturing. A lot of people said, oh, no big deal, because we're not really that much of a manufacturing country. And then the service ones came in contractionary as well, weak. PMI, again, contractionary, weak, below 50, along with the ISM. Durable goods were touted as being strong. We had a read this week, but the bad news is they were roughly around the same as the previous read, and the previous read was really crappy. The Fed has been talking about autos and housing being strong, but, if they're going to really start hiking interest rates, those are going to start moving the wrong way. We could be at peak autos because people need loans to finance leases and stuff, and if the interest rates go higher, that's not going to be good for autos and housing. The good news is airlines have been doing well, but that's been sort of its own market into itself with these more light and efficient jets. I think it's also just a replacement cycle. There's so many old planes flying. They need to update with Wi-Fi and stuff. So I think that's just the airlines being competitive. But for me, the things to really look at there as well is, a strong dollar will hurt those, Caterpillar and stuff being less competitive. Of course, the dollar is a key that the Fed is watching. That has backed off a bit, so that could give the Fed a little bit of cover. But if that starts rallying again, it might box them in. And of course, the 7th one that goes unspoken, which is the S&P 500. So with that said, let's take a look at the S&P, because that often is the most important one, even though it's the one that they sort of are loath to talk about. So if you take a look at this period of time here we're in with this back and forth seesaw, I had equated it being similar to this period of time. Now, the question is it going to resolve higher and lead to more consolidation or finally a real breakout? Or is this going to consolidate and do this, and instead of rallying up, it's going to kind of collapse? I'm not necessarily sure either way just yet. I will say this, the market doesn't have any excess, meaning there hasn't been a blow off top. Usually markets do, but we didn't in 2007. We had the financial crisis instead, and the market did collapse. So you can see we had these equal bottoms here. Usually when a market sort of starts to roll over, we get symmetry. So I don't know that this time is going to be the same where it resolves higher. It could be that this one resolves lower because we're on the other side of the mountain, so to speak, this being one side and this being the other. So we'll have to take a close look as to what happens there. The good news is that we're not going to need to really think that much about it. We're going to just do it based on levels. I think that if you take the human factor out of the equation, it saves a lot of heartache and pain. So take a look here. We have reference areas that we know are important. The 208.97 was a past reference high. We know that there was support around 206.76, and 204.12 was important. We have 201.90, and then the must hold of the lower end of the range, which is 197.87, below that consolidation range, and you could kind of say toast. With, I guess, a little bit of leeway give to this gap fill of 195, but the more time we spend below 197.87, the weaker and more flimsy and more susceptible to crashes, in my view, that the market will be. We are nowhere near there, however. We did hold the bear flag high of the consolidation of SPY, which is good. You'll see when I keep that in mind when I talk about IWM, which is not holding it, but we'll get there in a minute. So we held there again. We had this low and then these two basic double, but this was basically a double bottom, slightly higher low, and we've had a short squeeze rally. You can tell that these were kind of P profiles, low volume week, and we are back up above the 204.12. However, we are below the 206.76. We are below 209.97, and then the ultimate arbiter has been this resistance up here around 210. Anything below 210 to me really keeps the market keeps a bit of a cap on the market. Anything below this 206.76 to me is still a little bit suspicious, because you can see that's really where up in the close to these 207s is where this larger volume distribution takes place, and you'll have a lot of people who bought up here who I believe took profits here. There might be another round of that. We'll have to see. So I'm really using this bar here, this kind of sideways range as the where I want to be long or short. Anything really above here is more bullish. Anything below here starts getting more iffy. So I do believe we are kind of smack in the mid there. We're expecting about I believe it's close to a $3 move. Let's see, $2.97.5 for next week. So let's just roughly call it $3. We closed at 205.68. So that would basically take us up to 208, closer to 209s, which is kind of roughly around here. If we wound up falling apart, you'd be roughly around back down to here. So it's really a question of where we are in the range, the lower part of the range or the upper part of the range. For now, I guess until we have a definitive break, I guess it's short the rips and buy the dips still, but being cautious that this could be, like I said, the other side of the mountain, and that really has to be right or right out if you're playing long against these lows. I will say this: if you are bearish, we are still making lower highs, still making lower lows. If this area were to be taken out, this kind of triple bottom, that should be a pretty nice cascade down, and I think we would fill the gap. We probably would see this range low. That would be a point to kind of trim and trail and then play kind of for the gap fill. I like that with put spreads on a break here and put ratios for sure on any break there against maybe the 61.8 as your short strike. So that's my view. I really need to kind of see the market break down out of range or up out of range for me to make a decision on direction here. I will say it is still a little bit vulnerable. We're failed basically on the 200. We're on the wrong side of the 50. Maybe we have a continued rally. Never short a dull market. I think some people learned that the hard way this week. We're in thin holiday volume. I believe next week is also a 4-day week with New Year's at the end of the week. So I think we'll kind of get a better read on this maybe after the first week or two in January. You tend to have some new money allocated. I'm not sure if this time is going to quote unquote be different. I do see there being a lot of risk after the first quarter maybe of the new year, because I think that's when March would be when the Fed would maybe hike again, and then you have a lot of people who are selling May and go away, and March and April kind of are close to there. So around then could probably be a little bit more severe market risk. We might be in for a lot more of this sideways chop for a little while to come, believe it or not. IWM, you can see we're below the bear flag high. We held it on SPY, but we did not here. We already filled that gap, and now we're kind of bouncing back up to try to retest into this range, bound near these hammers. I've said for a while, anything below the 117.37 and anything below 120.58 is a little bit vulnerable. I want to just show you something interesting. If you look from the high down to this low, look where the 61.8 comes into play. It's really close to this 201.58. It's around 120.65, 120.65, and you have 120.58. We didn't quite get there. We failed a little bit there. So really this area is the key, I believe. So anything on south of that remains vulnerable. Anything north of that to me is bullish. I think if we can clear that and hold it, we would see a retest of the highs. So just keep that in mind. You probably won't hear that from your TV commentators, but believe it or not, that is really the right way to look at it. Qs, kind of still the poster child of strength. We did make a slightly new high here. These are kind of almost like little triple tops, but really consolidating in the upper part of range. Really hard to knock this. I mean, you don't even have a 50 or a 61.8 pullback. I do believe, by the way, that this 105 would be a buy if we did have some type of a rollover for a right or right out type of trade. You have some reference lows here around 104.24. The 61.8 is there. You might press through a little bit, but I believe between the 104s and the 105s would be the right or right out play. If you're bearish and we start coming down, put ratios or spreads around that area, I think will be winners. A lot of the fate of the Qs, though, as we know, are determined by a handful of stocks, 4 or 5 really, to tell the truth. So let's get right into FANG, and let's do it in the FANG order. Facebook, I believe, is in a consolidation pattern similar to here. If you're playing long, the 50-day has really held it right or right out against the 50 for a long, and could do the same with a short on a snap of the 50. And these double lows here, the low here being 103.60, this low being 103.86. Anything below there to me gets a little vulnerable for some type of a larger pullback. I've been saying I hope we do get a larger pullback ahead of earnings, somewhere into one of these fibs or reference breakout levels to set up for a long again. But Zook is on paternity leave. He's been busy with this charitable foundation. I've been a little bit of critical. Congratulations to him in real life. I'm not knocking him in that respect, but I am saying if you are a shareholder and you're expecting new products and innovations to come out from Facebook, is it really likely that those are going to happen where Zook is on paternity leave when he's not around to do an event to announce them? The answer is no. So there's no event risk, shock risk to the upside. Hence, we're getting the consolidation. The stock has been overbought for a while. It ran a lot on Google like it did here. It needed some time to cool off, and it's doing that. So as these stochastics come down, the lower they get and the weaker the stock is into the earnings, to me, would be set up for a long. It's that simple. Amazon has been a beast. We know it's taking a lot of share from all the retailers, Macy's, Nordstrom's, you name it. It's been holding. I said 660.64 was key. We had a violation here, got back up above there. These are poor highs, so this, I think, was just subject to a liquidation break. Still well above the 50, which has been holding. If there was some type of a break here, I think you can buy it off these kind of double bottom lows of a 50-day moving average. I like that with put spreads or put ratios, better ratios, so you don't have any loss of premium outlay. But anything above 619.45 really is still kind of bullish. It is just consolidating. The stochastics are rolling over a bit, so it wouldn't surprise me to see it fall out of bed a little bit. I would love an opportunity to buy it on primary trend, particularly ahead of the numbers, which I think will be stellar. If these kind of just stay sideways, the play gets a little bit more iffy. But this pattern probably, I would be surprised if Amazon has seen the highs, although this is a really tough long for me to first initiate or to give the okay to initiate into. Again, if you're a momentum player, just put a buy stop up above these highs. I think any move above there should be a short squeeze and probably will resolve higher. So I'm either interested in buying it lower or on the breakout over momentum for a right or right out play. There's really not that much to do here. Maybe play very near dated strangles or condors or something along those lines. The other A, which doesn't really get much respect these days, is the Apple, the biggest weighted stock in the Qs. You can see this is looking a lot like a big rounded top, sort of what I said, the other side of the mountain here. We did break a important trend. We violated it with the flash crash, although it did close above it, and we are kind of rolling over. 109 is important. We lost that. We got to the 107s. That kind of was lost, but we retested, and we're kind of failing back here. Anything below 109 to 110 is vulnerable for still lower. Above there is kind of neutralizing. You probably could see the 111s and maybe the 115s again, but I'm a little cautious on this. It's good that the stochastics rolled over. I would love to see this do a little bit of a shake and bake where it sells off further, gets the IV jumping, and gets people all panicked ahead of Apple earnings. Maybe they didn't sell as many watches or iPhones or whatever. That's always a great setup for a long. So I'm kind of fingers crossed here, hoping that this sells off into their print to set up for a shake and bake for a long. We'll see if I get my druthers. Apple usually tends to rally ahead of there, but maybe this time we do get a little bit of panic. That would be the ideal situation in my view. So that is Apple. One thing. Any loss of 107s puts 103s and maybe 100s in play. Anything above 109, 110 puts the 11s and the 15s in play. So those are the real key levels. Netflix. I said that this looked a little reminiscent here, double top-ish, starting to roll over a bit. As long as it holds above 115.03, it's still a long. You have a 50-day moving average there, now a double bottom. But if it loses that again, I think you'll see the 109 to 110 again, and maybe even the 103.88 to 105. I would, again, another one, I would love to see sell-off ahead of the number. Being that it's coming from an all-time high, there probably would be some type of a responsive play. So in selfishness, I would love to see this roll over to set up and maybe get the channel low or these reference lows for a right or right out trade for a long for earnings, but we'll have to see how that goes. Google, also just kind of consolidation mode, really not that much to say. This was a little overbought, although it has worked off a lot of that. I have thought we would see these channel highs somewhere close to the into the 800s. Ideally, again, this would be another one that would, if it sold off ahead of the print, would set up well. We could see it rallied here the last time and then did sell off and consolidated and then was off to the races again. So, rinse and repeat. If you're long already, 50-day moving average caught it. That will roughly probably coincide with the 752.05. So that is your kind of right or right out if you aren't long, or right or right out as a short on a snap. A couple of stocks that have been in the news. Chipotle. We all know it's sold off quite a bit. I said 115 here. 515, was key. We lost that, and we had made some new lows. The good news is that we are kind of getting late in this move. And you got earnings coming up. The 472.41 and then 442.40 was really where the stock broke out from. So if there is some type of consolidation here and then a move lower ahead of the print, that could set up, believe it or not, for a long. You'd have sucked in a lot of shorts, shaken out a lot of people. Ideally, that would play out ahead of the earnings. So we'll see. Look, you had 1, 2, 3, 4, 5. This was like the 6-day down. I think a lot of people were chasing this. They got themselves a little overly short. So, like I said, the next kind of leg down into this area, I believe, is where you want to start selling out of the money puts into. Disney. We all know Star Wars came out and was, a huge success. I saw the movie the other night. It was fantastic. I'm not going to give a spoiler, but a little disappointed with a certain character that was killed off. Very disappointing. That's like a piece of my childhood. God. Anyway, we all know that this was down bad on ESPN. Worries. It did hold on a closing basis. The trend, higher low, basically retested. Now has rallied enough to put in a significant lower high and rolling over again. I don't know that the story for Disney is over, but I will say this. It's pretty bearish here that we're making lower highs and lower lows. And I do believe that we will retest maybe the 99 level, potentially even the 95s. So I do like put ratios as this comes lower. The good news, I guess, for the bulls is that we have used up a lot of the time for the rollover, and it is sort of starting to bottom out. There probably will be some type of a responsive bounce. My guess is ahead of the earnings. If it sells off into earnings, it's a long for earnings. If it rallies hard ahead of there, it could be another opportunity to short. So we'll have to see how that plays out. It's going to be a Costanza of doing the opposite. Kind of like Nike, and I think we'll end on Nike. They rallied strong on earnings, sold off. It was a complete reversal, and then had some continuation lower. The good news is that this close did manage to stay above this swing high. Swing low. I think that there's a lot of volume here. I think there were a lot of people who were afraid of another Skechers situation. They figured that the report was good and they'd have a lot of volume to kind of get out into. I think that this was also, and the same thing that's going on with FANG. I think it's a lot of fund managers who had a lot of gains. There weren't a lot of stocks this year that had a lot of gains. It was a very narrow market, and I think that they were just locking them in for the year end. So my ideal situation here would be Nike has more earnings coming up, would be for this to sell off, to get back down into some of the, like maybe 50, 51, 52 area, if we're lucky, even maybe a little lower, somewhere near this trend line and this reference low, and then set up for some type of a long situation. We could continue and have some type of a bounce. I actually suspect that this will probably be the more likely case, that we do have some type of a bounce in Nike, but like I said, if I had my druthers, it would be some type of a more dramatic sell-off. Get the stochastics oversold, get to some reference area lows ahead of, near the number, and then set up for a long. But, anything below this this low here, the earnings day, is 63.91, is still a little bit vulnerable. If you start losing these lows and this swing low on closing basis, then it's really GTFO. So if you're long, you don't want to see any closes here below 62.84. Anyhow, that's my story. I'm sticking to it. I did create a new Instagram account, Justin Pulitzer Trades. I'll put the link to that in the description below. I do 15-second videos before the open each day for what the market is keying off of. I'm curious to get some feedback on that, so please do send me a tweet. If you're not following me on Twitter, it's at Justin Pulitzer. I post a lot of trades and video links, and if you like this video, be sure to hit the like button below, leave a comment with some feedback. It's always helpful, and subscribe. You'll get notifications when I post new weekend review videos, as well as Periscope rebroadcasts and special edition videos. So I hope everyone had a good holiday. We'll have a good new year, and cheers.